Check, please.
Hey, welcome back to Everything Money. If you've watched any of our videos in the past, we use an 8-pillar system to analyze and assess stocks. Paul's going to go through why we chose these 8 pillars and what a real true investor is looking for when trying to analyze companies and their stock price. Paul, let's talk about them.
So when we first started doing individual stocks, Seth called me one day and said, Paul, when you look at a stock, what do you look at? And I rattled off a bunch of things.
Yes.
And we counted them. There were 8 things, okay? This was a starting point for any stock I looked at. It just happened over time based on my reading and understanding and learning, and also owning and operating my own businesses, where I said, what are the things that matter to me? Those things, those 8 pillars have changed a little bit. Okay, we've changed 2 of them to be more relevant to publicly traded companies. Now, this doesn't mean, and it's a very misunderstood thing, when a company has all 8 pillars, it doesn't mean go out and buy it. Like I said, it's an initial screening to kind of give you an idea of what questions to ask next about a company. That's merely it. Is it beneficial? Absolutely. Absolutely. If you watch our videos, you'll see us look at 8-pillar stocks and non-8-pillar. I own a company, Carnival Cruise Line, which is all 8 X's, but I still own it because of the future potential. So,
if you've been out there wondering how to invest in stocks, this was a simple question that I asked Paul. If you think you just buy them on hope or just hope they go up, we're going to bring you an approach about the 8 simple steps we look like in terms of fundamentals. So Paul, let's get after it.
So I'm going to bring an example company. I always talk about Microsoft or Apple because there's a lot of revenue growth, et cetera. So let's pull up Microsoft. So this is our website, which I'm sure you've seen many times, which you can join at everythingmoney.com for only $1 per day. Let's just pick up Microsoft right here. All right. So the first thing we do is we start out with the 8 pillars. This is the 8 pillars page, right? And it lists all 8 pillars right here. Pillar number 1, we want the 5-year PE ratio to be under 22.5. So what does that mean? What the software is doing is it takes the last 5 years of profit. So you go to the income statement, it pulls all these 5 numbers. It adds them all together. Then it takes the market cap of the company, which is all the shares outstanding multiplied by the share price, and it gives you this market cap. It divides the market cap by the total profit over the last 5 years. Typically, we want a 1-year PE to be 15 or so historically. Over a 5-year period, we want to account for some growth. So we pick a higher number. And based on my testing things here and there, looking at them, 22.5 seemed like a reasonable number. If the number was less than 22.5, great. Now, does this mean if it's less than 22.5, it's a cheap stock? No. Hypothetically, let's say you have 2 companies. Both are selling for 20 times 5-year profit. One, revenue is declining 5% a year, and the other one, revenue is growing 20%. Are they the same company? No. You should want to pay less for a company that has lower growth or is losing revenue versus one that's growing fast. Just like if a company has a 5-year PE of 50, that doesn't mean it's a bad deal. In all likelihood, it's probably expensive. But again, if it were to grow 30% a year for the next 20 years, you would all day long pay 53 times PE for that company over the last 5 years, correct? Because more growth means more potential profit in the future. And you shouldn't cut your nose to spite your face because of growth. Growth is an important aspect. But when we look at PE, it's just a starting point for that standpoint. Okay? Pillar number 2, we want the 5-year return on invested capital to be greater than 9%. Now, return on invested capital.
This is ROIC, which is news to me.
Now, ROIC, guys, is calculated in many different ways. We base it on the cash flow of the business over the last 5 years divided by the total debt and equity of the business. There are 2 ways to fund a business, debt or equity. And we want to see what kind of return are we getting on the debt and equity that's invested in the business. If a company is able to make a lot of return on all the debt and equity in the business, they're going to be able to build up profit a lot faster. They're going to be able to take the money that's in the business and create more profit from it. Does that mean it's always the case? No. But all in all, that's the way it is. And you should be willing to pay a little bit more money for a higher return on invested capital versus low return on invested capital. This is one of those metrics that is often misunderstood. And to be honest, a lot of people who are financial experts don't understand it fully. I don't understand it 100%. I just looked at the way that I would look at it if I was a business owner. Okay, the debt and equity in business is basically the entire enterprise value of the company, right? What's the total value of the business right there? Not the enterprise. Essentially, how are they making cash flow based on that? Are they able to get a good return based on that? Okay. Now, again, I look at it from the standpoint of I picked a lower multiple of 9 because of the fact that as time goes on, it's growing, that percentage will be lower and lower. Just like the inverse is true for PE. That's a higher one because the inverse isn't a percentage, right? So that's, when we look at this thing, it's not a matter of, Charlie Munger will say that over long periods of time, the ROIC of a business is basically how much the business is going to grow at. That's if you pay a reasonable price and everything is normal. Because at the end of the day, you can have a massively overpriced company. Microsoft has a 54 PE, 5-year PE, but a 17.4% 5-year ROIC. You're telling me if you buy Microsoft right now, you're going to make 17.5% of your money? No. And the other thing is, which one? The 5-year ROIC? Because the 1 year is 24%.
Mm-hmm.
It just says Microsoft does a really good job of making profit, making cash flow on the money invested in the business, and that's it.
Pillar number 3 is revenue growth over the past 5 years. Obviously, we want to see our companies growing.
Guys, very simple. We just go to the income statement, and it's literally look at the revenue 5 years ago. Revenue today, is it positive? It's just a way of saying, okay, this company is growing. Now from there, you've seen our other videos, we analyze, okay, was there a big jump last year? Was it consistent growth? Was it not consistent growth? Were there big fluctuations? But at the end of the day, we want to look at longer trends. And I want to find companies that are growing versus declining. Does that mean I'm opposed to declining companies or I'm going to buy every company that's growing? No. Again, it's all part of the story. It's all part about looking at this, and this is a very, very simple metric. Is it growing or not? Is it growing from acquisitions? Is it growing from natural growth? The way I find out if it's growing from acquisitions is I go to the cash flow statement, and I go to the investing section. I look at acquisitions and dispositions. If I see a lot of acquisitions that are large, that are driving the revenue, that's not as good as growing on its own. This is all just part of the story we're trying to tell and understand about the company.
Yeah, pillar number 4 involves their profit. So don't get fooled out there with these high revenue numbers. If they're not making any profit, that's where there can be a disconnect. So go ahead, Paul.
Yeah. So, just like in everyday life, people always brag about their revenue. Why? It's the higher number.
Yeah.
So would you rather own a business that makes 10 million in revenue, but has profit of 1 million, or a business that has 5 million in revenue has profit of 2 million?
Oh, Paul, I just got the numbers for that business we were going to buy with a partner. They did 4 million in revenue, 300 grand in profit.
That's pretty low.
Yeah. So there's a lot of ins and outs. So
look at a company like this. Everything Money has a much higher percentage of profit versus FitActive Sports, right? So it's all about understanding these things. So very simple. Is there profit growth? We go to the income statement, go to net income. Is the number 5 years ago larger than the number today? Sorry, lower than the number today. The answer is yes. Great. That's it. Again, it's just part of telling the story. Is that number consistent? Is not consistent? Look at Microsoft. I immediately look at, whoa, how did it go from 13 billion to 71? Well, the year before that, it was 22. And the year before that, it was 11. So I look at this going, okay, there were probably some write-offs here because they were consistently making high numbers, drop, big again, drop. This is all part of telling a story. I have to understand what happened in those 2 years. I hope you're seeing the pattern here with these 8 pillars. It's about telling a story.
Paul, pillar number 5 involves a subject matter that when I speak to normal people about investing, I have yet to ever meet anyone who's brought this up when they're talking about these exciting, wonderful companies. It's shares outstanding, the actual number of shares a company has in this world, whether it's to their employees or shareholders. Go ahead.
So guys, if a company has 10 shares outstanding and they make $10 a year, that's $1 per share. Fair enough. Very easy. If all of a sudden they issue more shares to 15, they want to finance something, and instead of issuing debt, they issue shares, and their profit goes from $10 to $15. If you're just looking at profit numbers, you're like, oh, wow, 50% growth. But guess what? It's still $1 per share. So you owned part of a business that profit went up by 50%, but your share stayed the same. Because when companies issue shares, they are diluting you as an owner. And I call this the silent killer in investing. Everybody, I love it. Everybody looks at the profit of business as this company is growing. Yes, but if they're issuing shares like crazy, they're not doing any benefit for you. Now, what's better? Let's say this company, I told you, hey, this same company 10 years from now is going to make exactly $10. All these other idiot people out there would sit there and say, this company was flat, it did nothing. Oh, but I didn't tell you something else. They bought back 4 shares. Now, all of a sudden, it's 10 divided by 6. It's $1.66 per share in profit. So even though the profits stay the same, they decrease the number of shares. You now get a bigger piece of the pie. If you're willing to pay 15 times profit for this business before, $15. The same 15 times in profit, $25. That's how you drive up the share price, by buying shares back. And you want to do it with companies that are cheap. You don't want a company buying its expensive shares back. Just like you're investing in expensive businesses, you want the company using their cash to invest in an inexpensive business, and hopefully it's themselves to buy back shares. That's the key here, guys. Make sure you understand this, because nobody, and then there's an idiot out there who I shall remain nameless, Tom Nash. He sits there and says when you issue shares, it makes the market cap go up. Nothing could be further from the truth. Mm-hmm. It's absolutely asinine. Just like when a company pays a dividend, the stock price should go down by the cash in the account, because now that company is worth that much less. Mm-hmm. So same thing here. We want to sit there and focus on the things that matter. This matters, but this in and of itself doesn't matter. This matters, but this in and of itself doesn't matter. This matters, but this in and of itself doesn't matter. What matters is the whole picture. Pillar number 4 matters, but not by itself. Pillar number 5 matters, but not by itself. That's the point. We're here to understand the whole picture.
Pillar number 6 is total long-term liabilities divided by 5-year free cash flow, and we want this multiple to be less than 5.
Okay, so first, why does debt matter? Guys, debt for companies and all finances for businesses are just like your personal life. The more debt you have, the more risk you have of financial issues. If the economy slows down, you lose a job, your income decreases, something happens, you get sick. Same thing with a company. Now, after looking at a lot of metrics and how I want to value companies, I sat there and said, okay, I'm going to look at a long-term average. So what I did was I took the 5-year average free cash flow number, which is right here on the main page of our software, and I multiply that by 5. And I want my total long-term liabilities, all the debt that's owed in the long run, to be less than that number. And right here, that'd be $256 billion or so. Is that correct? Roughly. No, I'm wrong. $216 billion. I want the long-term liabilities less than that. Some companies are more, some companies are less. For a company like Microsoft, it's really low. Microsoft has 2.37 times, so half that number.
What's a terrible company that has a ton of debt? Didn't we do?
Well, I wouldn't say terrible necessarily, but AT&T has a ton of debt.
Yeah.
AT&T has an absolute ton of debt. What's another video we just did?
I think you're right. AT&T.
There was another one with 16 times.
Yeah, was that Sony or?
Sony.
Yeah.
Now, I'm not, again, in and of itself, one metric does not always matter. It's about looking at the whole grand scheme of things. Are they growing revenue a ton? Did they take on a lot of debt to grow the business or buy a business that's adding a ton to the bottom line? I don't know. But you want to look at long-term trends and understand it. I would also go to the balance sheet and look at their long-term liabilities at the very bottom. Are they staying consistent? 173, this is by the quarter, and it's going down, up, down, down, up, down, down. So, okay, over the last 10 quarters, 11 quarters, it's about $8 billion higher. All right. They have stable cash. They have very growing cash flow. It's great. They have a lot of potential. I'm not worried about Microsoft. That's the way to look at things. AT&T with 12 or 13 times debt, when the business is stalling and they're not growing revenue, that's a little worrisome.
So one of the most important pillars, maybe the most important, and how you look at other companies, Paul, is cash flow. Now, for a normal person like me, it took me a lot of reps in my mind to understand what the difference between a profit and a cash flow is. So explain it to us and why it's so important.
So cash flow is the money in, money out. It's cash from operations less your capital expenditures. Net income can be affected with write-offs, depreciation. Cash flow is just the money in, money out. Now, is it possible to manipulate the number? Of course. but it's harder, okay? So what we do for pillar number 7 is we look for cash flow growth. Now, we added this line to our software because we didn't want you to have to do the math. We added this free cash flow line because it's cash from operations less your capital expenditures. And we just look at 5 years ago and today. Is the number higher? If the number's higher, check mark. Okay? Very simple. I want to see a company that's growing its cash flow, just like I want to see a company that's growing its net income. One of the things I want you to remember, though, is over long periods of time, cash flow and net income should be pretty similar. That's one way to figure out a fraud, or one way to figure out if the CEO and accounting department is manipulating the numbers to make things look rosier. If the net income is drastically higher than cash flow over long periods of time, red flag. Major red flag. Okay? Keep that in mind as you're looking at your companies. Very much keep that in mind. If you see the cash flow greater than net income, doesn't mean that's an amazing thing. Understand why that is.
Now, if they have a lot of cash flow, they can do things with it, Paul. What are some of those?
So great question. Here are the 5 things you do with cash flow. You can pay down debt, buy back shares, issue dividends, make acquisitions, or reinvest back in yourself. These are all great things to do with the cash flow, just like your personal cash flow. You can do one of those 5 things with your personal cash flow too.
Yeah.
No different than a company. Cash flow is the true lifeblood of the company, in my opinion. And since most people don't look at cash flow, they look at net income, it's often overlooked and an opportunity to find hidden value or a situation that's not as good as they maybe make it out to be.
Pillar number 8 is how we transfer this cash flow number into paying an appropriate stock price or a market cap price if you're trying to buy the whole business. And Paul, this really spoke to me. The concept of moving from a normal person to someone who's somewhat qualified to be an investor is envisioning that I'm buying the entire company and spending the money on that market cap. What would I be getting? Right.
So guys, what I said before about free cash flow and net income should be pretty similar. We'll look at their ratios. Microsoft 53.72 PE. And this is their 5-year free cash flow number. Pretty much spot on. So something tells me from a 500-foot view, there's probably not much manipulation or any shady things going on. And it's very simple. We take all the free cash flow the last 5 years, we add it together, and we take the market cap and divide it by that total number, and that gives us our ratio. So basically it says Microsoft's free cash flow the last 5 years has equated to their net income over the last 5 years.
We want this number under 20, and in an elevated market, we're seeing pretty high numbers above 20.
Like look at the NASDAQ 100. I went and did the numbers for the NASDAQ 100, and I think that number is like something insane, like 40 something. I don't remember what it was. It's an insane number for the NASDAQ 100. For 100 stocks in the NASDAQ, it's an insanely high number. That's what tells me, okay, things are overpriced as of February 1st, 2022. But all of these together, guys, all of these tell me a story. What does it tell me about Microsoft? It's expensive. Now, obviously, if you watch our videos, the stock analyzer tool, which is phenomenal, will tell us how expensive it is based on the growth levels. But I'm looking at this company saying, worst case, I'm adding it to my watch list because eventually it'll be at a price that I really enjoy. Eventually it'll come to a price that I'm going to love it because guess what, guys? The company can control a lot of these. It can't control these. So this tells me the company's operating well. These green check marks tell me this company is operating pretty decently. These red check marks tells me that the average investor doesn't understand, is overpricing its potential. So I just need to wait for the average investor to start hating the company because they'll probably still operate pretty decently going forward.
If this resonates with you, if you were out there in the past just randomly buying stocks and hoping they go up, I'm hoping that looking at these numbers, it really resonated with me, Paul. So you can have all of this in front of you. You don't have to search Google's and the finance pages, dig through multiple tabs to find these numbers and somehow do the math yourself. You can have the financials. We offer it through everythingmoney.com. Paul, tell them how.
So we created the software because when we first started this channel, one of the most common questions we got was, how do I get the data behind you? Because we were using another service. So we invested hundreds of thousands, hired 4 or 5 developers, created the software. It's all available fully on your mobile phone. You get everything we did in the video. You get everything that's coming up here, including the current retirement calculator, 8-pillar portfolio, exclusive daily content, 1-2 videos a day from Seth Mo or I on the app. You get the 8-pillar portfolio. You get everything that's coming up, but most importantly, guys, the biggest thing is most of our users are alone in how they think. That's why they're drawn to our channel. But when you don't have people to talk to you, it can feel like a very lonely road out there. We have our amazing chat community with over 6,000 people that you can talk to about all your investment ideas. And guess what, guys? It's not everybody who agrees with us. We have people on there who say, Paul, you're wrong about crypto. You're wrong about Tesla. Great. It's about engaging in conversation and talking about your investments. This is all available on your mobile phone for $1 per day. If you can just increase your returns by 1 or 2% or decrease your losses by 1 or 2% a year, it will lead to hundreds of thousands, if not millions of dollars in retirement. It's a no-brainer, $1 per day, 2 ways to sign up, everythingmoney.com or Patreon. The benefit of everythingmoney.com is that you don't pay sales tax yet because we're not big enough. So go sign up, and that price you pay today is locked in for the future at that level. The price goes up every month. You'll stay at the price you paid for that level. So sign up now, everythingmoney.com. Go sign up, $1 per day, no brainer.
We want to be your lifeline if you need guidance and help on how to invest, a process. You can take over your finances and not trust some random financial advisor. You have no idea what he's doing behind the scenes. We'll be here for you here at Everything Money. We want our app and our videos to be your go-to site to learn. That's our take on 8 pillars. Keep watching. This takes a lot of time. It's taken me years, Paul. And so it's a language you can learn and really excel with, and we'll be here to help you.